Currency. It is the agreed medium of exchange for goods and services. Before currency, people traded items directly, which was highly inefficient. Today, governments issue fiat money, which has value purely because a society agrees it does, and the government backs it. The value of a specific currency fluctuates against other currencies based on national economic health, trade balances, and political stability. If a country exports more than it imports, demand for its currency rises, making it stronger. As a beginner, you must understand that holding cash is a position in a specific currency. If your local currency weakens against global reserves like the dollar or the euro, your international purchasing power drops. How to use this to earn and master money? Do not keep all your savings in a single, historically weak currency. If you live in an economy with a volatile currency, convert a portion of your long-term savings into stable foreign currencies or hard assets. You can also monitor exchange trends to buy foreign currency when your local money is strong and sell when it weakens, though this requires careful timing. Central and regular banks. Think of the banking system as a two-tier structure. A central bank is the government institution that manages a country's money supply and oversees the entire financial system. It does not deal with individual citizens. Instead, it acts as the bank for regular commercial banks. Regular banks are private businesses that interact directly with you. They take your money, keep it safe, and lend it out to other people or businesses, charging interest for the service. The regular bank makes a profit on the difference between the interest it pays you and the interest it charges borrowers. The central bank regulates these regular banks to ensure they do not take excessive risks with your money. How to use this to earn and master money? First, ensure any regular bank you use is officially insured by the government, so your money is protected if the bank fails. Second, shop around among different regular banks. They compete for your capital. Compare their account fees and interest terms carefully. Move your funds to the institution offering the most favorable conditions for your specific financial goals. Central bank rate. This is the baseline interest rate at which the central bank lends money to regular commercial banks. It is the most powerful tool a government uses to steer the economy. When the central bank rate is low, regular banks borrow money cheaply, which means they can offer cheap loans to businesses and individuals. This stimulates spending and economic growth. However, if the economy grows too fast, prices rise. To cool things down, the central bank raises the rate. Borrowing becomes expensive, spending slows, and price growth stabilizes. How to use this to earn and master money? You must adjust your strategy based on this rate. When the central bank rate is high, it is suitable to put your money into deposits and savings accounts because regular banks will pay you higher interest. Conversely, when the central bank rate is low, it is a bad time to save cash in a bank, but an excellent time to take on credits or mortgages because the cost of borrowing is cheap. Lock in fixed low rates for long-term loans when the central bank rate hits the bottom. Inflation and deflation. Inflation is the general increase in the prices of goods and services over time. It means that your money buys less today than it did yesterday. A low, predictable level of inflation is considered normal and encourages people to spend rather than hoard cash. Deflation is the opposite. It is a general decline in prices. While cheaper goods sound good, severe deflation causes consumers to delay purchases, which forces businesses to cut wages and jobs, leading to economic recession. How to use this to earn and master money? Inflation silently destroys the purchasing power of uninvested cash. To master money, you must ensure your wealth grows at a percentage rate higher than the current inflation rate. Do not keep large amounts of money under your mattress or in zero-interest accounts. Buy assets that historically appreciate during inflationary periods, such as real estate, productive businesses, or inflation-protected bonds. During rare periods of deflation, cash becomes more valuable over time, so holding cash and paying down debt quickly becomes the smartest financial move you can make. Price formation. In a free market economy, the price of any good or service is determined by the intersection of supply and demand. Supply is how much of a product is available. Demand is how much consumers want to buy it. If demand is high but supply is low, the price goes up. If supply is abundant but nobody wants to buy, the price drops. This simple mechanic dictates the cost of groceries, real estate, and your own labor. When external factors like weather destroy a crop, supply drops, and the price of that food spikes. How to use this to earn and master money? You must apply supply and demand to your career and investments. To earn a high income, you must acquire skills that are in extremely high demand but short supply. Do not train for a saturated market. In investing, look for markets where supply is strictly limited but demand is reliably growing, such as land in expanding cities or rare commodities. Buy assets when temporary oversupply makes them cheap and sell them when high demand drives the price up. Credits. Credit is an arrangement where you receive money or goods immediately and agree to pay for them later, almost always with an added percentage called interest. There is a fundamental difference between good debt and bad debt. Bad debt is borrowing money to buy things that lose value over time, like clothes, vacations, or expensive cars. This drains your future income to pay for past consumption. Good debt is borrowing money to purchase assets that will generate more income than the cost of the interest, like a profitable business, education that leads to a higher salary, or real estate. How to use this to earn and master money. Never use consumer credit cards to fund a lifestyle you cannot afford. Pay off your credit card balances completely every single month to avoid compounding interest. However, you should deliberately use long-term credits like mortgages to buy appreciating assets, especially when interest rates are lower than the average inflation rate. By doing this, you let inflation eat away the real value of your debt, while the asset you bought increases in value. Deposits. A bank deposit is money you place into a banking institution for safekeeping, typically in exchange for interest payments. There are different types of deposits. Checking accounts offer immediate access to your funds but pay almost no interest. Savings accounts pay a modest yield but might limit withdrawals. Fixed-term deposits, often called certificates of deposit, require you to lock your money away for a set period, such as 6 months or 2 years, in exchange for a significantly higher guaranteed interest rate. The bank uses your deposited funds to issue loans to other people, paying you a fraction of the profit. How to use this to earn and master money. You must maintain a liquid checking account only for immediate monthly expenses. Move your emergency fund into a high-yield savings account to earn passive income while remaining accessible. For money you know you will not need for a year or more, utilize fixed-term deposits. Always time your fixed-term deposits when the central bank rate is peaking, thereby locking in a high guaranteed return before rates eventually drop again. Stocks and stock market. A stock represents a fraction of ownership in a real operating company. When you buy a share of stock, you literally become a partial owner of that business. The stock market is the digital exchange where these shares are bought and sold. Companies issue stocks to raise cash for expanding their operations. As an owner, you make money in two ways. First, if the company grows and becomes more profitable, the value of your share increases, allowing you to sell it for a profit. Second, many established companies distribute a portion of their profits directly to shareholders as cash payments, called dividends. How to use this to earn and master money. Over long periods, the stock market has consistently outpaced inflation and bank deposits. You do not need to be an expert to participate. The most reliable method for a beginner is to buy broad market index funds, which hold small pieces of thousands of companies at once. Invest a fixed portion of your income into index funds every single month, regardless of whether the market is up or down.